G'day folks, it's Jim here from Orchard Forex, and it is Saturday the 31st of July. Well, the month has ended. The US dollar made a little bit of ground up on Friday, but the dollar index actually lost about 0.75% over the course of the month, with most of the losses coming following the dovish comments from Jay Powell at the FOMC meeting last Wednesday and Thursday. Looking ahead, much is going to depend really, I think, on the progress in fighting the Delta variant of COVID. We have to see how that goes, but the general theme seems to be that we're going to continue to see good economic growth, albeit at a slower pace than previously markets had been anticipating, with the usual bottlenecks of supply and labour being the main impediments to the market. In the commodities area, gold had a good month. That finished back above 1800. It lost a little bit of ground on Friday, but it's still well back above the lows. While oil also had a good bounce, having fallen to $65 a barrel following the OPEC meeting mid-month. It has bounced pretty strongly since then, and close to July at $73.70, I think it was. So that was a good bounce, and once again, the outlook for risk sentiment really is going to be the key driver ahead. But we've also got some fairly important stuff on the calendar this week. We start off with the manufacturing PMIs on Monday. We bookend that with the US jobs data and non-farm payrolls on Friday. And in between, we've got central bank meetings from the Reserve Bank of Australia and also the Bank of England. And there's plenty more aside from that as well. So it's going to be a pretty action-packed week, plenty of opportunity. Anyway, without further ado, we'll go and have a look at the charts.
Okay, so here we have a daily chart of the dollar index, and start there as usual. Now, this time last week, the dollar index was in the process of trying to break the neckline of this inverse head and shoulders. And really, as we said last week, it needed to get on with it, and it actually didn't. And as we suspected, we've seen a bit of a reversal lower. The market, I think, was getting itself set up for a further rally to the top side for the dollar, and market got itself caught long and wrong, basically. So we've had this reversal. We actually made up a little bit of ground on Friday, but the daily indicators do point lower to start the week off. So I wouldn't be surprised to see the dollar remain a little bit heavy in the next couple of days. But having said that, we have got support down at this level here. This is the 100-day moving average and the 200-day moving average. That's at 91.5 and 91.35 respectively. So that's going to be good support on the downside. That would equate to the euro trading roughly up to 119.45.50 if we see it there. But it does look to me as though that could be the direction the next couple of days. But having said that, if we move forward to the weekly charts, the weekly indicators, as you can see, the momentum indicators do still look mildly positive. Let's widen that up a bit. They do look mildly positive. They may be flattening out. So I think we need to have some caution here. But really, I think we're probably going to stay below this neckline in the next few days at least. The non-farm payrolls on Friday is going to be the big game changer. It's forecast to be close to 1 million jobs created in the month of July. I think if we go above 1 million jobs being created, that will give added confidence to the market, and that could give the dollar a boost. But until then, we wait and see. It may be just that we chop around. The PMIs will be important on Monday, and Europe seems to be making a quicker recovery at the moment vis-a-vis the States. So it wouldn't surprise me to see a little bit further of euro strength, dollar weakness, and head back down towards that 100-day moving average that we just pointed out on the daily charts around this level, 91.50, 55, something like that. So going forward to the euro, and we start the euro with the 4-hour charts. And as you can see, the euro lost a bit of ground on Friday as the dollar made a bit of a comeback. And the 4-hour charts actually do point a little bit lower to start the week off. So maybe we do move back down towards Friday's lows around 118.5, and perhaps back down to sort of 118.25, where these highs come in here around 118.25. But the PMIs will be the guide on Monday. If we go forward to the daily charts, though, the indicators do point higher. The RSIs and all the momentum indicators look pretty good for the euro. So potentially we can go up here and look at this this level here. Now the moving average actually is to 119.75. That's the 100-day, and the 200-day is at 120. Perhaps we get there in the next couple of days. Not really sure, but I think that's what I would rather be doing at the moment, is looking to buy short-term dips as per the 4-hour chart down to this 118.25, and looking probably to unload them at around this 119.5 level. I don't think we're going to see much outside that range on Monday, and possibly we might be contained within that right through to the non-farms on Friday. If we go even further forward to the weeklies, the momentum indicators are pretty neutral. They're sitting 50-50. The stochastics might be a little bit oversold, but RSIs and the MACDs are pretty neutral. So I'm not expecting too much there at all, really, as far as directional bias is concerned. On the weekly charts, note that we have got the 55-day moving average. That comes in at that 119.5 level as well. So that may add a further cap to any potential upside momentum. For the time being, just trade the range, but I like to buy it at 118.25, sell it at 119.5, basically. Moving forward to dollar yen. So here we have a 4-hour dollar yen chart, and dollar yen fell really from sort of the highs around 110.5 to a low of 109.35 last week. Finished above the lows, 109.65.70. Looking at the 4-hour charts suggests we might see a minor recovery on Monday to back towards 110 perhaps, but the dailies, if anything, beginning to look a little bit heavy. Having said that, we have closed above the 100-day moving average, and also we've managed to hold on above this first FIBO level here. Comes in at to 109.5. I think a break below there, we can then head back to this low down here, which we saw on that 16th of July, that's at 19th of July at 109.05, and a break of that could see us move back towards 108.5, 108. I don't really see anything dramatic happening there early in the week, but if safe haven demand does come to the fore, then we may see some demand for the yen, and that may keep the dollar under pressure. Potentially euro yen may be a decent trade, sell euro, buy yen, if you wanted to stay away from the dollar. But if anything, I'd rather be selling rallies, I guess, so in the 110 to 110.30 area, looking for a move back down towards 109. But there's not an awful lot in it at the beginning of the week, I don't think, really. If we just go forward and have a quick look at the weekly charts, the momentum indicators, let me just blow this up. Momentum indicators aren't really telling us an awful lot, possibly pointing a little bit lower. So to come down here, this is the 200-week moving average is at 108.88. So if you were to sell it, if you were able to sell it above 110, and you kept your stop loss, I would say above 110.50, but you should keep your take profits down here around it's just below 109, I think, because I'd be surprised if we break below the 200-week moving average ahead of any outcome from the non-farm payrolls. Sterling's enjoyed quite a good run higher, really, from this 136 level up to just shy of 140, basically on the UK coming out of its COVID lockdown. But it did give back a bit on Friday and closed at 139 a figure. The 4-hour charts are suggesting we're probably going to see a little bit more downside for sterling on Monday, but we have got the PMIs out. The dailies are mildly positive. Unfortunately, we weren't able to close above the 100-day moving average here. That's at 139.25 or so. But if we can take that out, then we move back towards this 140 area. And beyond there, there's not an awful lot really, but ahead of 141 to stop us going higher. I'm not sure the momentum indicators are strong enough really to take us that far at the moment. And it's like to be the non-farm payrolls on Friday, which decide the direction. Although remember that we have got the Bank of England meeting on Thursday, and the statement there will be closely watched and provide the initial direction for cable. The Aussie and the Kiwi are pretty singularly uninteresting. We'll just have a quick look here. This is a daily Aussie chart and it's drifting ever so slowly lower. If we go back to the 4-hour charts, it's really, for the last week or so, it's just really moved sideways in the 73 to 74 range. Don't really see too much change there. The 4-hour charts are pointing slightly lower. The dailies are not telling us an awful lot, and I guess a lot will really depend on how quickly Sydney can come out of lockdown. We're currently locked down here until the 28th of August, apparently, and that's not going to do us any good at all. But if the COVID numbers do start to reduce dramatically, that'll probably be a positive for the Aussie, and we will probably move back towards the 74 level, which capped it on Friday. And on the downside, 72.90, which was the recent low down here, that'll provide good support in the interim. I'm not really expecting too much. The RBA meet on Tuesday, they're going to remain very cautious, very dovish, I think. But it's probably pretty much written in, and it wouldn't really surprise me to see further 73, 74 consolidation for the coming week. And the same really applies to Kiwi. That's even more boring than the Aussie. It's just chopping sideways, as you can see. I think with the Kiwi, you probably sell it, well, you probably sell it above this high here, sort of 70.40. It went the high last week, 71.15, 17. I'll be looking to sell it in the 70, 20, 30, 40 area, with a stop loss above here, but above 71, say 10. On the downside, be looking to buy it around 69 the figure, with a stop loss below this sort of 68, 80 low. But that aside, I'm not really too bothered about the Aussie or the Kiwi at the moment. I think they've probably got more sideways choppy trade ahead of them. Moving along to the stock markets. Okay, so here we have a 4-hour chart for the S&P. Now that's it did come off a little bit on Friday, but as you can see, it's hovering pretty close to all-time highs. I don't think this weakness that we saw late in the week has done any harm. It's allowed the 4-hour charts to alleviate their previous overbought condition. The dailies not telling us an awful lot. They're pretty flat. The weeklies are still overbought, but they're not really showing any signs of wanting to come off at this point in time. So we've got this major trend line here on the weekly charts, and as long as we hold this, which is at sort of 42.80 and climbing towards sort of 4,300, as long as we can hold that, I think we probably see a very slow grind higher in the stock markets, as we've been seeing really for months and months now. If we come back to the 4-hour charts, on Monday we're going to see support down here around this 43.60. And the resistance is going to be at this sort of 44.20 level. So for the time being, I'd trade that range. But as per normal, I prefer to buy dips. Now we can come back here, of course. And if we do see it down here, I suspect it'll be because of a poor number coming out of the non-farm payrolls on Friday. Can't really see any reason for it to move sharply lower until then. So I would really be trading this range here, as I say, 43.60 to 44.20. The Dow equally, this is a 4-hour chart, that's sitting near its all-time highs. The Nasdaq, a daily chart of the Nasdaq, once again near the all-time highs, possibly pointing a little bit lower. But the results from the big FANG companies last week were pretty good, apart from Amazon, which missed expectations, albeit it was a seriously big number anyway. But it did miss expectations, so that fell 7%. And had dragged the indices slightly lower into the Friday close. But August is a new month. It is still the middle of the US summer holidays, so I'm not really expecting too much either way. On the Aussie stock market, here we have a chart of the ASX 200, and having been trading in this sideways channel for months and months, well, several months back to May, we broke above it and we really haven't got on with it. But I think it's encouraging that the Aussie market is trading close to highs, despite the fact that we're in lockdown and New South Wales is in lockdown, Victoria's been in lockdown. So the 4-hour indicators not telling us an awful lot, possibly got a slight positive bias to them at the beginning of the week. The dailies, likewise, not doing an awful lot, but they don't look as though they're going to fall out of bed. So I prefer to buy the dips. And on Monday, I think if we saw it back down at this 73.70 level, I'd be surprised, but I'd be looking to buy there. Having said that, this 74.5 level is the all-time high, so I'd be very doubtful of going above there, at least until the RBA meeting on Tuesday, and then we have to see how it goes from there. But with COVID still rampant in New South Wales, it wouldn't surprise me really to see us hug close to current levels, this 7,400 level, and will take direction as the week develops and the COVID numbers develop. Gold. Well, gold had a pretty good week. This time last week, I was a bit concerned that we might have a head and shoulders formation building and a break below this support. would have taken us a fair bit lower, but the market obviously saw that as well and got itself caught short. So we've seen a bit of a bounce to 1830. Came off a little bit on Friday as the dollar recovered, finished at 1815. The 4-hour charts look a little bit negative to start the week, so a move back towards 1800 wouldn't really surprise. The dailies are not telling us an awful lot. We really need to see a daily close above this sort of 1825 level, where the 200-day moving average is. In the meantime, on the downside, the 100-day moving average is 1795. That's been the case for the last couple of weeks, so we've been trading that range really. We have tried to break above it, but without much success, and we're probably going to have more of the same. Longer term, I'm still a fan of gold. I think it's going higher, but we have to bide our time on this one, and right for now I'll be looking at trading the 1800 to 1830 level with probably a $10 stop loss on either side. And finally, we'll have a look at oil. Okay, so here we are. So we saw this collapse down to 65 after the OPEC meeting. Since when we've had a decent recovery. The oil market seems to look pretty positively towards economic growth and the potential demand for oil. The 4-hour charts do seem to be topping out a little bit. The dailies possibly winding up for another move higher, and the weekly charts not telling us a great deal. So for the time being, I would imagine it's going to be fairly choppy. I think this level here, 75.5, will be toppish, and I don't think we're going to go above the recent $77 high. On the downside, we closed at 73.70. This level here should provide some decent support. That's sort of 72.25. So I'll be looking to buy it there, sell it above 75, and I'll have a stop loss down here, basically below 70 or above 77. I think that trade that range, but not looking for too much. Wait until the non-farm payrolls on Friday and see what that brings us. Now we'll go and have a look at the calendar while I think about it. Okay, so here we are, and starting off with Monday, the main events are going to be the manufacturing PMIs, as you can see, with the ISM being released later in the day. So that'll be the main event of this session. Tuesday, start off with a fair bit from Australia, home loans and building permits, but it'll be the RBA decision. No change to policies expected, and it'll all be in the statement and what Philip Lowe has to say. And then Wednesday, we start off with the Kiwi employment data, and then we've got Australian retail sales and all the services PMIs, which will be released throughout the day. So that'll be the key driver there. Thursday, not an awful lot really until we've got the Australian trade back. We've got the Australian trade balance, but the main event will be the Bank of England meeting. Once again, no change in policy expected, and it'll be Governor Bailey's statement and speech that traders will be looking towards. Then on Thursday, Friday, we got another speech by the RBA Governor Philip Lowe and the RBA monetary policy statement. But the main event of the day is going to be the non-farm payrolls with 900,000 jobs expected. Now, if we go over 1 million, that could be a bit of a game changer, and we could see a fair bit of action then. But the unemployment rate is expected to reduce from 5.9% last month to 5.7% this month, with average hourly earnings remaining unchanged. So that's really about it. We've also got the Canadian unemployment numbers coming out. They'll get missed in all the action. But so it's going to be a pretty busy week, and we'll have to see how it goes. But there's going to be plenty of opportunities. But in the meantime, have a good one, and we'll talk to you next week. Cheers.